just being knowledgeable about how I spend my money and what I do with it while I'm in college and budgeting well.
It means an understanding of, I suppose, your income and how you spend that income.
I don't know what personal financial literacy means.
My name is Carol Carr, and I'm the Financial Education Specialist at the University of Kentucky Federal Credit Union. And I'm here today just to cover credit management strategies like your FICO credit score, your credit report, and how to manage debt such as credit cards and loans. A FICO score is a number that is calculated from your credit history that represents your credit worthiness or how likely you are to repay a loan. The FICO score is made up of 5 components. The first component is your payment history, which makes up the largest percentage at 35%. Next is your debt to credit ratio, which makes up 30% of your score. The next component is the length of your credit history, and that makes up 15% of your score. The last 2 components are the types of credit currently in use and new credit, and both of those make up 10% of your score. A FICO score ranges from 300 to 850. Anything 720 or above is typically considered a good score. Something to keep in mind whenever you receive your credit score is to make sure you know whether it is a FICO score or a Vantage score. The FICO score is most commonly used, but the Vantage score does exist. The original Vantage score ranges from 501 to 990, whereas the new Vantage score, the Vantage 3.0, ranges from 300 to 850. It's important to maintain a strong FICO score because it increases your likelihood for being approved for credit cards and loans, as well as the higher your credit score, the better interest rate you are going to receive. Some things you can do to maintain a good credit score is to make sure you're always paying your payments on time each and every month, as well as you're making sure to keep your credit card balances low. The debt to credit ratio does make up 30% of your score, so you want to make sure you're not using all of your available credit. So you want to keep your credit at a 25% threshold or lower at all times. When you're making a large purchase such as a mortgage, one of the best things you can do is make sure you're taking care of your credit score, such as making sure you're paying all of your credit cards and loans on time each month and try to pay all of your credit card balances in full. Also, with large purchases such as a mortgage, you want to make sure you don't open any new lines of credit, such as credit cards or an auto loan. If you do this, it can decrease your credit score as well as affect whether you are approved for the loan or not. So today we've discussed credit management strategies, and I hope you found it helpful. As you can see, credit plays an important role in many facets of your life, from mortgages to student loans to credit cards. So it's important that you take care of it as soon as you start using it. For more information, you can check out the Money Management Matters website.